How much do you know about economic indicators to help you make investment decisions? Do you really understand how to use economic indicators in investment decision? So watch this video to the end. We are going to discuss about how to use economic indicators and help you make investment decisions. So we'll start by interest, inflation, unemployment, gross domestic product, and currency, weak or strong. So these are the factors which we are going to explore. So let's start with interest rate. So if interest is high, what happens with the money? Borrowing becomes expensive. Mortgage rate, those with variable mortgage or those with mortgages which are up for renewal, becomes expensive. Credit card becomes expensive. So what happened in the industry, in the economy? High interest means companies will borrow less. The cost of borrowing goes up. The cost of borrowing, let me just say COB, goes up. So cost of borrowing up, that means borrowing goes in the other direction, goes down. So if borrowing goes down, that means less investment economy, less investment in the economy. That means less growth. This might lead to unemployment, lower stock prices. As an investor, you have to invest in a consumer discretionary stocks. Stay away from stocks, those companies that produce luxury goods. So what happened to the bond price? High interest. The bond price and interest, the inverse relationship. If one is going up, the other one is going in the other direction. High interest, it means bond price is going down. Lower yield and bond becomes less attractive. If interest is going down, conversely, the bond price goes up. So if you have a situation that you are anticipating interest to go down, like right now, the current situation we have like here in Canada or around the Western world, so you invest in bonds for the long term, right? Inflation can impact bond price and reduce the present value, and so interest raised bond price goes down. What happened to equities? When interest is high, business pay more to borrow money, which leads to high price for consumers, and which also reduce consumers. High price for consumers, what does that mean for the consumer? Consumer will reduce the demand for the goods. They will buy less, and that means the earnings for the companies will be impacted. As an investor, you have to pay attention to all these things and choose your stocks conservatively, carefully, because in this case we are staying away from luxury goods, again under high interest. The same applies with high inflation. High inflation reduces consumer buying power and makes the cost of goods more expensive, and consumers tend to stay away from luxury goods. Which stocks do you invest? Defensive stocks, stocks whose goods are inelastic. The demand does not go down or up. In 2021 and 2022, the central banks around the world have been fighting inflation, which had been induced as a result of the supply chain constraints in the aftermath of the pandemic. So they had to raise interest, increase cost of borrowing, and in doing that, they would lower the demand and bring down the prices. Here in Canada, we experience about up to 9.5% inflation. Right now, it's within target, somewhere in the neighborhood of 2.8, depends with the data which you factor in. So investment strategy under these conditions, if you are anticipating interest to go down, drop soon, you buy long-term bonds, about 10 years. Bond, because as I said, that bonds and interest, they inverse relationship. If one is going down, the other one is going up. Lower interest, high bond price. The other aspect which we also look at, gross domestic product. What is gross domestic product? It's a measure of goods and services produced in a particular country with a specified data. We collect data and we measure. So if GDP is up, what does that mean? This means economic growth. If the economy is growing, higher consumers are spending. Consumer spending, corporate profit is up. Corporate profit is up. Employment also, companies tend to hire more, and also their stock price tend to do well. This is growth. If P is shrinking, it can shrink within a short period, but not necessarily a recession. Because what is a recession? The rule of the thumb is 2 consecutive quarters of negative growth, but it can be within a specified time. So So if GDP is going down, consumer confidence tends to follow. Consumer confidence again goes in the same direction down. People are spending less profit and the stock price might also be impacted, right? And in this case, when GDP is up, you invest in tech stocks. You also invest in consumer goods. You also invest in the luxury goods. They tend to rapidly increase, right? In this case, also, fixed rate bond becomes less attractive as compared to other investment vehicles. We tend to have stocks doing very well under growth. Stocks when GDP is expanding, stocks tend to do well. Instead of buying the bond, which might be less, we tend to go for stocks, and which will have better return. You will have better return on these stocks. Another indicator which I also talked about is employment or employment in general. So if there is high unemployment, it means consumers are spending less consumer confidence, and also be less productivity and less profit for the company, lower stock price. In this case, the central banks, as I said, the central banks might be, doesn't necessarily follow, but they might be lower interest to stimulate growth. So as I said before, lower interest, it means money becoming cheap to borrow. Companies go out and borrow more, invest more, and expand more, and then hence create jobs. This is how the central banks sometimes respond to high unemployment. But of course, it has to be a longer period for a certain specified period. Another indicator which we also was that of currency, money. If your currency becomes strong out in the economy, we have companies that export goods abroad. Their goods becomes more expensive and less competitive, and hence it will affect their profitability and it will hurt their profitability in the export market. As an investor, how do you invest? You stay away from companies that are solely dependent on exports, because they will be exporting less and hence less profit. So now, conversely, our currency becomes weak. There is a silver lining to the weak currency. It will boost export, and so our exports becomes competitive. So we go back to what I said there on about the companies that are dependent on export. The exports becomes more competitive abroad, but there is caveat this. We import inflation. With our import becomes expensive. Now, pending with whether the company has a trade deficit or not, that means if we import more than what we export, we end up having inflation in the market and making goods more expensive. And as a result of that, at some point, the central banks might intervene with monetary policies. Another issue which we also have looked into, another indicator which we have, these are geopolitical events. Things like election in a given country or in certain parts of the world. That, say, a good example, the Brexit. It had certain economic impacts on the British economy. And also wars abroad, they can disrupt supply chain, supply from that particular region, which might result in domestically experiencing shortages in certain areas. And also climatic conditions like the hurricanes, the tsunami around the globe might also affect supply chain. Say like if there is a tsunami in an area where we get raw material to manufacture certain goods here at home, so that means that company will be affected grossly. Last indicator we will touch into is technological advancement. Technological advancement tend to disrupt certain industries which are currently in existence. Say iPhone. When iPhone was introduced, it made certain very big company which was manufacturing mechanical phones go under. I haven't heard of it right now. I won't mention it in this video. And also now, how do we invest under these conditions? We have to follow the money. We have to go where the money is. So we have to go where there is this technology advancement. The iPhone industry or that particular technology is being produced, or the spin-off companies helped by that particular technology. Like streaming services, it disrupted the VTAP companies. And music streaming, it disrupted the CD compact disc companies. Ladies and gentlemen, these are the indicators which we look into in order to make sound investment decisions. Always look for this in the economy and decide how you are going to invest. Thank you for watching and subscribe to this channel.